Okay, so we're on chapter 8. It's on long-term assets. So last week we talked about accounts receivable, which is a current asset on the balance sheet. So today we're going to look at long-term assets. And I have a question real quick before we start. So last week we went over in detail with the asset accounts receivable. Was it easier to understand? I'm just trying to figure out if I want to switch things up on how the book presents the information. So we started with just kind of looking as an overview. We talked about the accounting equation. We talked about the accounts and what they were, which I think is fine to start. But then we kind of jump into how to put a financial statement together, taking all this information and bring it over. Do you think it would be helpful to switch it and maybe not do detail like that? I mean, do the detail first and explain really what an asset is, how it works, going through that motion, and then talk about bringing it to a financial statement? I'm just curious.
Yeah, I feel like that's better.
I'm just trying to figure out if that might help understand, because a lot of times when you go to work in a business, you would start at a position, you maybe wouldn't start at a high up position looking at an overview. You would start in a position that is maybe doing one thing and kind of learn that and then move to something else like that. So I didn't know if maybe the same thing, learning this material would be easier if you kind of understood, okay, we're learning all about asset and liability. Let's say we do current asset, long-term asset, current liability, long-term liability. You learn what those are real good, ins and outs of the flow, and then jump back to how does that impact the financial statement? It's just a thought.
It makes sense.
So I'm just curious, if y'all have any input on that, just go ahead and email me and let me know. Because I'm curious, maybe I'll change the format a little bit if I teach this course again. Okay, so we're talking about assets again, balance sheet account, right? And the asset is something that's going to provide us some sort of benefit in the future. And we talked about receivables a lot, but there's other current assets that we can easily liquidate outside of our cash. But now we have these long-term assets. So it's not going to be sitting on the current section of the financial statement. It's me sitting under the non-current or long-term asset section on the balance sheet. So we're going to focus on those. We're going to focus on tangible assets, things that you can see, touch, like machine, building, land improvements. We'll go through that. Anything that we use in operations would be considered one of our assets. So if we have a business and we have equipment that helps us manufacture shirts, and that's all we do is produce these shirts, different sayings on them, and sell them off to wholesalers. Well, if we did something else, like maybe we bought a piece of property and then we were going to use it for something and then sell it later, that's not really an asset that we use in our operations, because that's not what we do. What we do is produce t-shirts. And for an organization like I work for, that would be considered our operations, because that's what we do. We own buildings and rent out to tenants. We have land, we develop on the land. And so that would be something that would be in my operations. So different companies will have different types of assets that you'll be looking at that are part of their operations. I just wanted to make that clear, like just because you see, oh, this is, the land, it may not be something that's used in their operations. So the way that it's handled would be a little bit different. Okay, so then we can expect that benefit from the future. So if I'm buying equipment, I expect that I'll be able to use it maybe 5 to 10 years, depending on what it is, and I'll have some benefit from it later. And so I want to think back on the principles and know that I want to match some of those costs of this equipment and this expense to what am I benefiting from it in the future. And so if it's t-shirts that I'm producing, this machine's producing t-shirts today, and I would need to expense stuff that matches my shirts today. But I also know that I'm gonna be selling those shirts in 5 years, and I wanna have some of that expense from that same equipment 5 years down the road. We're trying to match that matching principle. Okay, and then we also call it property, plant, and equipment, PPE. So it's just, if you hear that, every organization's a little bit different on how they refer to their assets. So if you hear property, plant, and equipment, that's their fixed assets. So we talked about the cost principle. So we have to have a cost that we recorded on the books. In order to put that asset on there, we have to have our cost. So what is our cost? Usually we have, the purchase price. We also have, sometimes we have to do something to assemble that asset in order to get it ready. So we have those costs. It could be transportation costs. Sometimes there's costs that are associated, not just the purchase price, but there's other things that are associated with it. And we would include all of that. Okay, so we have machine and equipment. So in the machine and equipment, we're actually physically getting something in. So we'll have that purchase price. We'll have the transportation. Sometimes in transportation, you want to make sure you cover it with insurance. That's going to be part of the price of that asset. Taxes and the installation would go into whatever it takes to assemble it to get it into working order. That's what we're saying when we say installation. Then you have buildings. You may buy a piece of property that has a building on the land. So you actually have two assets. You have the land, you also have the building. So the building will be the cost of the building itself, or the construction of a building, or the construction that you have to do to bring it up to the level that you want. And so you have all of those costs that are included with that purchase price. And then you also have title fees, brokerage fees, attorney fees, taxes. So when you go to the active sale, you'll have all of these costs listed out for you. And some of those costs you can capture, and that would be included in the price of your assets. So you wouldn't expense those. There's some things you can expense, but other things you would include in the price of your asset. Then you have land improvements, which are parking lots, driveways, fences, walkways, and lighting systems. So if we do any improvements, that would be considered the land improvement. We would also set that up as an asset, and we would set up some form of depreciation over time. Then we have land. So land, again, you buy land, you have to go to an active sale. So you're going to have the purchase price, title insurance, property taxes, real estate commissions, surveying fees, legal fees. Now this one's not a depreciable asset. So you would not set land up to depreciate over a period of time. Okay, land just goes on the books, and it just stays on the books until you resell it. You either sell it at a gain or a loss. There won't be any expense unless you do some sort of land improvements, and those will depreciate. So think about the land improvements, driveways, fences. They're not always going to stay brand new, right? They're going to depreciate over time. So you want to set those types of things up, but the land itself will not be depreciated. Okay, so we can do a lump sum purchase. We can buy multiple assets together for one price. And you have to figure out, how am I going to put this on the books? How am I going to determine or allocate the cost to each one of those assets? So if I'm buying land, building, maybe some equipment can go with it, and I'm purchasing this all together and I'm paying one price, then I have to look at what is the fair market value of all of those assets. And it may not match up to what you paid, because what you paid may be less, but you would use that to come up with an allocation. So I want to go through an example real quick with that. So CarMax paid $90,000 cash to acquire a group of items. So we pay one price, $90,000. So we know that that's our cash that's going out. So it tells us that we have land that's appraised, which is the fair market value of $40,000, and a building appraised at $60,000. So notice that the appraisal is for $100,000. So I broke it out for you. So the appraised value is $100,000, but we're only paying $90,000. So we want to figure out, okay, how do I determine what my percentage is? So that's how we're going to come up with the allocation. You have to take those assets that you purchased, add them together to come up with a total. And then we're going to figure out each percentage of that total. So we'll just take the 40,000 for the land over the 100,000 to come up with our percent, right? So it'd be 40% for the land, 60% for the building. Okay, so we have 90,000 that we paid for everything. So now I just take the percentage that I figured out from the fair market value and multiply it by what I paid to come up with how much for land, how much for the building. So 90,000 times 40% is 36,000. And then I do the 90,000 times 60%, 54,000. Make sense? So we only paid one price, 90,000. And the way you come up with your percentage here is to do this. Look at your appraised price or your fair market value price, whatever it gives you, and your problem, and add them up, get a total, and then whatever the fair market value is for each one of those assets, you just divide by that total to come up with a percentage, and that's the percentage that you multiply the total you paid to come up with what you would put it on the books. Okay, so let's say I want to do a journal entry to put this on the books. So I'm spending cash. So is my cash a debit or a credit for 90,000? Cash is going out. Credit. So I know I'm crediting cash 90,000 because that's how much I paid for it. Now, because I've done this allocation, I know how much to set up my assets. So I need to record them onto the books. So I say land, 36,000, building, 54,000. That's my debit side. And then cash, 90,000. So that would be my journal entry to get it on my book. So my cash is going out and I'm exchanging it for another asset. So I have a debit to asset and I also have a credit to asset. So it's just a wash. So my accounting equation is still in balance. Now we talked about depreciation a little bit already, straight line depreciation. So what is the depreciation? It's a process of allocating the cost of a plant asset to expense while it's in use. And usually you'll have three things: the cost, the salvage value, and the amount of years that you'll have for a useful life. So you need those three things in order to do the calculation. When we did this before, we talked about straight line. Like we're just saying, okay, here's my value and here's my salvage value. I know how many years. So I'm taking that cost minus the salvage value divided by the number of years. And that gives me how much I'm depreciating each year. Real simple. It's just the same every year. Tonight, we're going to talk a little bit more about different methods. Straight line is what we've done already. We'll go over that in just a second with an example. Then we have units of production. So sometimes it's tied to how many units are we producing. We got to figure out how to expense it because this year I may produce more than next year. And so I'm using that equipment more. So I want to expense a little more. And then there's something called double declining balance or declining balance. And that one is a little bit more aggressive and you're going to expense more in the beginning than you will in the end. And so we'll walk through each one of those. All right, so straight value. So we have a cost of 10,000. We have the salvage value at 1,000. And the number of years of the useful life is 5. So the formula is the same that we learned earlier, cost minus the salvage value divided by the number of years. And this gives me the whole year. So we have to pay attention to dates, because maybe we won't have a full year, and we'll go over some like that. So if you're calculating the whole year, it would be $1,800 that I have to expense for the year. So let's just say we bought this equipment on January 1. We began using it right away. So what is my entry? I have to record that on the books when I purchase it. So I have my asset on the books already. My cash went out, so that entry's already been done. So now we're at the end of the year, and I'm only doing my depreciation entry once. I'm doing it at the end of the year. So what's my entry going to look like? It's an adjusting entry. Since it's an adjusting entry, there's no cash, right? I just need to record that expense. Okay, and I need to reduce the value of that asset, because now it's no longer going to be worth $10,000 because I've been using it all year. So once you buy your car and you bring it off the lot and you've been driving it for a year, it's not worth the same, right? In a normal economy today, maybe it's worth more. Who knows? Because you can't find new cars. Is what I hear. I haven't tried to buy a new one, but heard it's a little difficult. Okay, so let's do our entry. So do we remember what the expense is called? What the account is called for the expense? It's going back a few chapters. Do y'all remember? We're doing depreciation and we want to expense it. It's called depreciation expense. So we'll have a debit to depreciation expense, because remember, when we want to expense something, it's going to be the debit. How much? $1,800, because I'm doing the entire year. What's my offset? Remember, I told you that you can't do a credit to the asset account. We have something called a contra asset account. Does anybody remember what the contra asset account is to fixed asset? What it's called? Accumulated depreciation. Does that sound familiar? Maybe. Okay, so the accumulated depreciation is going to capture how much you've expensed each year. So each year, at the end of the year, you're going to do that entry. And the reason why is because you want to match that 1 year's use, that's your expense, with the benefit period, because you're using that equipment, you're benefiting from it, you're receiving some sort of revenue from having that equipment. And so you want to make sure that you record that expense in the period with when you have revenues coming in, that matching principle. So first year, this is what I'm going to do. Second year, I'm going to do the same thing. Third year, I'm going to do the same thing, all the way till I get to 5 years, and it's completely depreciated. Okay. So what happens on the balance sheet? So over here on the balance sheet, I'll have those non-current assets, or it could be plan assets. It may be titled differently, but I have, let's just say, equipment for $10,000. Then I'm going to have accumulated depreciation right under it for the amount that's been depreciated, and then it's going to give me the net book value. So the 10,000 less the 1,800. So now after that first year, the asset value on the books, even though I still have 10,000 in that equipment account, what's the value of the net book value? Because I have that accumulated depreciation in there. It's going to show up on the balance sheet. It's a contra asset account. So it's still an asset account. It's not going to go in the income statement. It's going to sit there the whole time that that asset's there and reduce the amount of that asset so that it shows a net book value. Each year it'll go down because each year we're using the equipment. So the books are going to have a net book value of 8,200. Okay, so let's look at the balance sheet after 2 years. So we did one full year was 1,800. The second year, we're gonna do another 1,800. So that's 3,600 that we have expensed for the first 2 years. So this is the second year. So you'll have that machinery on the books for 10,000, less the accumulated depreciation of 3,600, and then you'll have that total of 6,400. Your net book value is 6,400. So if you're looking at a balance sheet at the end of the first year, you're going to see the net book value at 8,200. I'll look at it at the end of the second year, it's going to be 6,400. Does that make sense? Each year, we're going to depreciate a little bit more until we get down to our salvage value. That's straight line. And that one should be pretty easy because we did that one once before. It's kind of a review. Okay, so now we have units of production method. So we have 2 steps in the process to calculate that. So we have to figure out, we want to figure out the depreciation per unit. And then depending on how many units we produce is what the expense will be. So we're just going to come up with how much is it per, and let's say this year I have a lot of units that I produce, well then it's going to be a higher percentage, right? Because I'm going to multiply it by the number of units. So how do we get that number? We're going to take the cost less the salvage value, so that's the same, divided by the total units of production. So the problem is going to tell you how many units you're expecting to produce in total. So once we do that, we know per unit now. And then the problem's going to have to tell you how many did you produce that year. So we take that number, which is the depreciation per unit times the number of units that are produced for that year. So that period. And that will give you your depreciation expense. So it's a little bit different. We're not just saying it's going to be even. It's not even if we're producing different amounts each year. And so we want to come up with a different amount to match what we're actually producing. All right, so the example says we have 10,000 cost, salvage value 1,000. So we have a depreciable cost of 9,000, 5 years. And the units inspected are 36,000 shoes. So we have 36,000 units that we're expecting. So we're taking the cost, which is 9,000. We took the cost of 10 less the salvage value to come up to 9, divided by the expected production, which is 36,000. So the 9,000 divided by the 36,000 is that 0.25 per unit. So now when the problem tells me, I'm assuming 7,000 units were inspected during the first year, depreciation would be calculated. How? 7,000 times the per unit. So my depreciation expense is $1,750. So the way I calculated the number to be expensed is different, but the entry is exactly the same. So when I'm ready to do my journal entry, I would do depreciation expense for the $1,750, my accumulated depreciation be a credit for $1,750. So you see, it's a little bit different. So my first year, the same example, 9,000 divided by 5 years gave me the 1,800. So I'm depreciating 1,800 as an expense. Whereas if I did the units of production, it would be a little bit different. I'm producing 7,000 this year. So now my entry is going to be 1,750. Okay, so it depends on the method you use on how you determine the amount. The journal entry stays the same. Okay, so let's look at double declining balance. So we have 3 steps now. So we need to know what the straight line rate is, which is the 5 years. They told us that. So we're going to do the 100% over the useful life to come up with a percentage. So you take the 100% divided by the 5 years to get 20%, or just do 1 divided by 5, or whatever number you have for your years to come up with that percentage. So we have 20%. Then we want to double that. So I'm going to take that amount and times it by 2. So right here, take 2 times the straight line rate. So now it becomes 40%. So now what I'm going to do is calculate out my depreciation expense a little bit different than I did on the last 2 methods. I'm going to say 10,000, because when you do double declining, you don't take into consideration the salvage value when you're doing the calculation for the expense until the very end. So I'm going to take the full amount, 10,000, multiply it by 40%. So now I'm going to depreciate 4,000. So you see, I'm going to use maybe that machine a lot in the beginning, and so I've decided I'm going to do the double declining balance. And that way I have the majority of my expense in the beginning when I'm getting the most production out of the equipment. So we went from 1,800 to 1750 to 4,000, right, with the same example. So this just shows you over a period of time how you would depreciate, but you always come back to that salvage value of 9,000 on the books. So, I mean, not the salvage value, you come back to the value of the asset that you're saying needs to be depreciated, which we pulled out 1,000. So we had 10,000 less the salvage value of the 1,000. So now it comes back to that full 9,000 being depreciated. Does that make sense? Just different on how we calculate and what the entries are for the year. Do y'all have any questions on it? Okay. So then we talked about just now doing a whole year. If we wanted to do a partial year, the only thing we're adding is we're going to divide it by 12, obviously, because we have 12 months, and multiply it by however many months you want to depreciate for that period. So in this example, I'm saying that I want to multiply it by 3/12. Well, that's because maybe I bought it in September, on September 1, and I only used it for 3 months, October, November, December. And so I only need to depreciate that 4th quarter because that's when I was using it. So I have 3/12. So instead of doing the full amount of 1,800, it would only be the 3 months, 450. So you just calculate it out like you normally do, find your yearly, you can divide by 12. That tells you how much it is per month. And then multiply it by the number of months you need, and that's going to become your expense. Okay, so we have an asset that we put on the books. We've learned different methods on how we can depreciate to expense. So now that we have this asset, now what's going to happen is sometimes we'll have things happen when you're using this equipment or in a building or whatever. There's going to be things that happen. So if I own a building and I've set that building up when I purchased it and I'm now depreciating it, something may happen and I have to spend some money. So let's just say it's some tenant calls and says, I had some problems with the plumbing. There's some, water coming in under the toilet, whatever. So I got to go in there and I got to fix the problem. So the plumber goes out and he comes back and says, okay, I had to repair some of these, issues. They had this valve and this gasket and maybe something with the pipe. I'm going to go ahead and fix those things. And it's, let's say it's $2,000. Well, it's a repair. All I'm doing is repairing it to get it to where it needs to be to continue to work, right? So I'm not really improving anything. I am just repairing. So when something like that happens, it's not really considered a betterment or improvement. It's only a repair to get me back into working order. And so you have to evaluate some of the things that happen. And sometimes it's hard. There's a gray line. May have multiple people trying to decide, is this a betterment or is it not? And then you go with it and hope you're right. So you would expense those. So that repair would just go to a plumbing repair. Because remember, my building, I have buildings that I rent out. So that would be considered part of my operations. And so that would go into normal operation expenses, plumbing repairs. Okay, so if it's something that needs to be repaired and it's significant, let's say that same building didn't have a little plumbing issue. They called and they said, oh, we have some major issues. We have a leakage like all out on the back of the building. And we go have somebody inspect the roof. And let's say there's a lot of the roof is damaged, the other parts are old, and we make a decision that we're going to put a whole new roof on this building. So now it might be $100,000, expense. Well, are we improving the property? At that point, yes, we're replacing. We're not just going to repair it in this one area. We're going to replace the entire roof. So we are extending the life now of that asset, because now it's going to have a brand new roof on it. It's going to be more secure. It's going to extend the life of the roof because I'm replacing the entire thing. So I would not consider that a repair. I would consider that a betterment. So now I'm back with another asset. So now I have a building improvement. So that would not go into my building account. It would go into my building improvement account as an asset. And I would decide, okay, how long does a roof last? What are the requirements for this roof in order for it to last this long? What are the guidelines from GAAP? And then you set it up to depreciate over that period of time. Does that make sense? Right? So we have repairs, and then we have things that we would have that are betterments to the property or to the asset. And we want to make sure that we put that on the books as an asset and depreciate it over a period of time. Because the roof isn't going to stay new forever, right? Maybe 20 years. And so if I get 20 years out of it, I'm depreciating it over 20 years. Okay, so this little chart kind of gives you the information that we just went over. So here's a journal entry for an ordinary repair. So I would do repair expense. In my example, I was a little more specific. I said plumbing expense. And I would put the amount of the repair, expense it in that period in which it happens. And then it would be cash going out or accounts payable set up to go out later. And if I have a betterment, it's setting it up as an asset. So my journal entry is to go to machinery or build an improvement or whatever it is, whatever asset it is. And so I would set it up for the amount, and then it would be cash. Okay, well, sometimes I will dispose of the plant asset. So I might decide to sell a property, or maybe the equipment that I've been using in production is old, and I decided that I want to get a new one because they're more efficient. I can, do fancier designs on my t-shirts. Maybe they have a little more bells and whistles now, and they're cheaper in price. So I'm going to go ahead and just upgrade. And I need to remove that old asset off my books. It depends on how you discard it, how much of it's been depreciated. Is it fully depreciated? Is it not fully depreciated? Did I sell it? How much did I sell it for? Sometimes you can sell it for more than what it's on the books for. Remember, I said we have a net book value. So we have that asset price less whatever we depreciated, and our accumulated depreciation is keeping track of that, because each year money's getting added into that accumulated depreciation account. So I need to remove that from the asset total to come up with a net book value. So let's say like that first example I did, that was $8,200 on the books for the first year, and I've decided, okay, let's get rid of that asset. We're going to get something else that's better. And I sell it for $8,000. Well, if my net book value is $8,200, I could potentially have a loss. Well, let's say I sell it for $8,500. Well, then I sold it for more, and I would have a gain. And so we have to know, how do we take care of that through a journal entry? We have to remove everything and set up the money coming in, and was it a gain or a loss, and put it in those accounts. Okay, so let's look at one. So we have discarding a plant asset. We have a machine that costs $9,000 with accumulated depreciation of $9,000. So what is my net book value? 0, right? Because I had it for 9, depreciated 9 already. So it says, it was discarded on June 5th of the current year. The company's depreciating the equipment using the straight line method over 8 years with zero salvage value. So how do I remove it? Well, on the books, so what does my books have? I have an asset, a machine at 9,000. Then I have that contra account, that accumulated depreciation account, wiping it out. So here's my net book value. How do I get rid of that off my books? What is an asset's normal balance? Debit or credit? Debit. So how am I going to remove my machine? Credit. So I know I'm crediting my machine. And if it's a contra asset account, what kind of balance it has, credit or debit? That accumulated depreciation is sitting on the books as a credit or a debit. Guess I didn't have to go that far up. I probably could have went. What are we doing here for accumulated depreciation? Credit or debit? Credit. So it's sitting on my books as a credit. So I have to debit accumulated depreciation for the amount that's sitting in there, which they told me is 9,000. So I have accumulated depreciation, 9,000. And then I have to get rid of my asset. So I have to credit. Now there's nothing left. I've wiped it out. Okay, so I'm just reversing what's on the books. So that's easy because it was fully depreciated. So whatever's in that accumulated depreciation account for that particular asset, I want to make sure that's what I use when I'm taking it off the books. I'm going to debit the accumulated depreciation for that amount. And then, of course, you have to use the full amount for the asset in order to get it off because that number never changes. Okay, let's look at another one. So we have equipment cost of $8,000, accumulated depreciation of $6,000 on 12/31 of the previous year, and it was discarded on 7/1. The company's using straight line depreciation over 8 years with zero salvage value. All right, so I have an asset that's $8,000. And it tells me that it's depreciated over 8 years. And there's zero salvage value. Those are the 3 things I need. And they're doing straight line method. So it's 8,000 minus 0, because there's no salvage value, divided by 8, which means I'm depreciating $1,000 per year. So when it says, I'm going to assume I've had it for 6 years because I have $6,000 already in the accumulated depreciation account is what it's telling me. So my net book value at the end of the year is the $8,000 asset less the $6,000. So it's $2,000. That's my net book value at 12/31. Now it's telling me that it's discarded on 7/1. So now this year I've had it for 6 months. So I need to figure out what do I need to depreciate to get me up to where I need to be when I sell it. So I have half a year, 6 months. What was it per year? 1,000. So since I'm doing half of that, so I'm just going to divide it by 2 to come up with 500. So this is going to be January through June. But I have to record the expense before I can remove it because I've had it for 6 months. I'm not discarding it until 7/1. So on my books, I do my entry, depreciation expense 500, that's my debit. I need a credit accumulated depreciation 500. So now what's in the accumulated depreciation account? The 6,000 plus the 500. So now I have 6,500 in my accumulated depreciation account. So let's look at a T account. So it's right here, 6,000. Just added 500 to it. So now my accumulated depreciation account has a credit of 6,500. All right, so now I'm going to discard it. I'm just going to get rid of it. Well, I have to take off the books what's in those accounts. I don't want to do more or less. We know the equipment is on the books for 8,000 because we don't touch that once we buy it. We're sitting as a debit. So I have to remove the entire amount. That's why the credit is for $8,000. We know we have 6,500 in our accumulated depreciation account as a credit. So I need to debit that for 6,500 in order to remove it. So when I do my entry, so now I'm going to have a balance of 0, and that's what I want. So I'm debiting right here my $6,500. So now I've gotten rid of my asset and I've gotten rid of my account accumulated depreciation, but what's the problem? They don't balance, right? My credits have to equal my debits, and the credit right now is more. So where does the difference go? Well, I'm discarding this. So now I need to expense that off the books because I didn't have it the rest of the time to put to depreciation. So now that I'm getting rid of it, it's basically a loss because I'm just discarding this equipment that I thought would be useful longer. So my account is called loss on disposal of equipment. So we'll look at one in a minute where we sell it and we have a gain, but I'm not selling it to anybody. I'm just getting rid of it. Does that make sense why I have a loss? Because I've said, okay, I'm going to have this equipment for 8 years. It's just an estimate. We think it's going to last 8 years. And maybe it's just not producing the way we want it to. We're going to get rid of this machine. And there's new stuff on the market. And so we've decided we're going to upgrade. Well, we want to wipe that out and expense the rest of it off. Okay. So that's how we get rid of it. That's how we dispose of it. We take a loss if we didn't estimate correctly and we haven't depreciated the whole thing like in the first one. All right, so let's say we sell it. So on 3/31, BTO sells equipment that originally cost $16,000. It has accumulated depreciation of $12,000 at 12/31 of the prior year. BTO uses straight line depreciation at $4,000 per year. The equipment sold for $7,000 cash. Okay, so we had a cost of $16,000. And then accumulated depreciation, 12,000. So this is all at 12/31 of the prior year, okay? So this is a year in. Now it's telling me on 3/31, I'm going to sell it, which means what? I've used it for how many months? 3. So before I remove it off the books, I need to do that adjusting entry to recognize the expense for the depreciation for the 3 months that I used it. Where they're telling me it's $4,000 a year. So now we got to divide it by 12, multiply by 3 to come up with what our number is. So we're going to say 4,000 divided by 12 times 3 months. So we have $1,000 roughly. Okay. So I need to put my entry on the books for that 3 months. That 3 months is $1,000 expense. How do we do our entry to enter depreciation? We debit on 3/31 depreciation expense, 1,000, accumulated depreciation, 1,000. Okay, so now in my accumulated depreciation accounts, I had 12,000. I'm adding another 1,000. So right now it's sitting with 13,000. How much was it originally? 16,000 was my asset, right? So what's the net value? 3,000 right now on 3/31. How much did I sell it for? $7,000. So you see I have a gain because I sold it for more than my net book value. Make sense? Okay, so let's get rid of everything. So we know we have accumulated depreciation, 13,000, right? That's what's sitting in my account. I know I need to clear that out to 0. Then it says my equipment was originally 16,000. Well, I know I got to do an entry for equipment for 16,000 because I got to get that off the books. So that takes care of the asset and the accumulated depreciation. Now I sold it for cash. How much cash am I getting? $7,000. Equipment sold for $7,000. So when I receive cash, is that a debit or a credit? Cash coming in, debit. So I have my cash. So now I recorded my money coming in. So now my bank will balance when I make the deposit over there. It's going to match on my bank side. All right. So what is my gain? It was on the books with a net book value of 3,000. I sold it for 7. So what's the difference? 4,000. And so that should be what I have to record over here. So if you look at your entry, the accumulated depreciation was 13. My cash came in with 7. That's 20, right? Over here, I have 16,000 because I had to clear off the asset. I need to record my gain. So gain on sale of equipment, or however you want to word it, 4,000. So now I have 20,000 on my credit side. So they're in balance and everything's been cleared off. And now I have a gain on that asset, which will go through to the income statement, and that will be part of your income for the year, that 4,000. It won't be maybe part of your operations, maybe it will, depending on what kind of asset it was. Okay, so that's the journal entry for the sale on a gain. Okay, let's do it with a loss. And this looks like the exact same. It didn't copy the right thing. All right, so I'm going to change it. Let's do the exact same thing, but let's sell it for 3,000. Okay. So I know my accumulated depreciation is exactly the same because everything's the same so far, right? I had to, I had 12,000 at the year end. I had to add 1,000 because I'm doing the 3-month adjustment. So now I have a balance of 13,000. I know my equipment is 16,000. So let's do what we know. Accumulated depreciation, 13,000. That's a debit. I'm receiving cash. Cash is coming in for 3,000. I know I need to get my equipment off the books for what I originally set it up for, which is 16,000. So I guess I didn't do that right because it didn't come out with a loss. It just matches. So I just sold it for what it was worth, right? Do you see that? See why? All right, let's do it if we sold it for 2,000. Okay, new entry. Accumulated depreciation, 13,000. My cash is going to be 2,000. And my equipment is 16,000. Okay, so now what's happened? On the books, I have this asset that has this net book value at 3/31 of $3,000. And I only received 2,000. So I had a loss of 1,000. So how do I put that on my books? It's gonna be a loss on sale of equipment or plant asset, or however you want to word it. So my loss is going to be a debit. So anytime that we're bringing in revenue, it's a credit, right? That's money we're bringing in. The gain was also a credit because it's money we're bringing in that we've made. So if you have a loss, just like an expense, it's a loss. So it's going to be a debit, just like an expense is a debit because it's taken away from the income. All right. So we have a loss of 1,000. And now I should be in balance. So I'm on the wrong one, sorry. I have a loss of 1,000, so I'll have the 16,000 on the debit side, and I'll have the 16,000 on the credit side. Does that make sense? So we went through the gain, the loss, and if we sold it for what was on the books by accident, but we did it. Okay. All right, let's talk just a minute about intangible assets. So all this that we were talking about is tangible assets, things that you can see, right? That they have a physical substance to them. Intangible, there's no physical substance, and it's an intangible. So it's a non-current asset without a physical substance. It often provides exclusive rights or competitive advantages, can have a limited life. It's usually acquired for operational use. So sometimes there are things that we can see, and sometimes there are things that maybe you can't see. I'm going to bring up the slide just to show you the list. So one of them is, I guess you can see them, patents, copyrights. So those are things that we know that are there. The patent usually lasts so long on something, and so you have the rights to it. And so that's an asset. If you were to purchase that from someone, that would be an asset for you to put on the books and then take care of it over a period of time, whenever that time expires. You have copyright, franchises, licenses, trademarks, goodwill. So goodwill is not something that you can see. It's not something that expires. So a lot of times if you acquire a business and you may be paid a little more than what that fair market value is, it may be because you can see the benefits in you owning that organization. So you will pay a little more for it and you'll call it goodwill. Okay, so it's an asset, you pay a little more money for it, put it on the books, and that eventually that gets evaluated and look to see if you need to adjust that goodwill amount. But that's for another class. Just know that it's there, that you have goodwill. And goodwill is not really something that you can see. It's usually just something that you acquire like when you have a business. It's the only way, I guess the best way I can explain it. So we have the right of use asset, leasehold improvements, research and development. So that's all the list of intangibles that you potentially will have as an asset on the books and that you are amortizing over a period of time. So this just gives you a little bit more information about what those things are, what a patent is. And so you can read through those if you want. Those are in the slides in the PowerPoint that I have on Moodle. So it's slide 51, 52, and 53. So this is the goodwill that I was trying to explain. This is the description that it gives you. It's an amount in which company's value exceeds the value of the individual's asset and liability, only recorded when the entire company or business segment is purchased. So you would put it on your books, and then, like I said, you would evaluate that from time to time. Okay. So what happens when you record that? You would record it the same way you would other assets. You would have to have some kind of monetary value associated with that. So you would have your purchase price, your legal fees, and your filing fees. So put them all together, put them on the books just like a regular asset. And then this is our formula for this week. It's our total asset turnover. So it's net sales over average total assets. Okay, so you're just taking the ending balance, the beginning balance and the ending balance, and divided by 2 to come up with your net assets. And then the reason that they would use that is because it's a way to measure the company's ability to use its assets efficiently and effectively. Okay, so it's just another way to have a formula that you can use looking at somebody's numbers on the financial statement, because ultimately, if you're trying to make a decision, you're going to want to test different things to see, are they able to pay their bills? You know, are they able to turn over their inventory? Are they able to turn over their receivables? How much is sitting on collections? So there's all these different tools, different formulas, you know, that we can use to help determine how the company's performing. All right, so let's look at some of the homework problems. We'll work through a couple of problems there. Let me just make sure it's not timed out. Do you have any questions? We just went over a lot really quick. Any questions? Okay. All right. So this says Perez Company acquires. Can you see that? I'm not sure how much you can see that on the screen. Let's see. Okay, Perez Company acquires an ore mine at a cost of $2,380,000. It incurs additional cost of $666,400 to access the mine, which is estimated to hold 1.7 million tons of ore. 315,000 tons of ore are mined and sold in the first year. The estimated value of the land after the ore is removed is $340,000. Okay, so does that sound like something that you would need? It's not worded the same way we talked about. It's a little bit different. So what is the cost? What did it say my cost was? I got $2,380,000 was the purchase price. Plus it's telling me I incurred additional costs of $666,400. So we would have to add those together. The $664,400 plus the $2,380,000 is $3,046,400. That would be my total cost. All right, and it's telling me at the very end of this, the estimated value of the land after the ore is removed. So that's my salvage value. That's what I'm expecting it to be worth after I've taken it out of the land. So I have $340,000 as my salvage value. So it's looking to see what is the amount subject to depletion. So I have the $3,046,400 less my salvage value of $340,000. Okay. So my cost minus my salvage value. And then I'm dividing by how much did it tell me that they were estimating I would get out of this land. They're estimating it to hold 1.7 million tons of ore. So that's what I'm expecting to use. So think it's not production, it's not a machine, it's a little bit different, but it's the same concept, right? I have, you know, something that I'm expecting to produce so many units. Well, this is, I'm expecting to get so much out of the land. I'm supposed to be able to extract this out. Okay, so does that make sense? It's just basically the same thing. It's just using depletion. Okay, so I'm dividing by.
Wait, how are you about to explain how you get depletion right now?
Yeah.
Okay, sorry. That you had already said it and I missed it.
No, I just did it. I'm taking the cost, which is the, oh, here we go. I gotta try to use this. Okay. I'm taking this 2,003,000 plus the 666,400. That's my total cost. So my cost less my salvage value. Here's my salvage value, 340. So cost minus salvage divided by that number that I'm estimating that I'll be able to get, which is the 1.7 million. And that's going to give me the per unit. Oh, Gotta do the mouse. Okay, so the amount that's subject to depletion is just the 3,046,400 minus the 340,000. That's where that 2,700,006 comes from. But if I need to know what my total is per unit, I have to use that 1.7 million. That's going to be my denominator under the total cost minus the salvage value. So it's that 2.7 million 6,000 over the 1.7 million to come up with that number of 1.592. Okay. Y'all see that? So once I know what it is per unit, when it tells me in the sentence, it says 215,000 tons of ore are mined and sold in that first year. Well, I know how much I sold. So now I need to know, okay, now I know my per unit. I'm going to expense out, I'm depleting that land by the 215. I've come up with an estimate that's per unit. So I'm just going to take that per unit and multiply it by that 215,000. So right here, see the 215. How do I do this? So I'm looking at this right here. I'm just taking the 215, multiplying it by the 1.592. It gives me 342,280. That's going to be the depletion expense. So instead of writing depreciation expense in your journal entry, it's going to be depletion expense. All right, so let's look at the second part of that. Okay, so it wants me to prepare the journal entry to record the cost of the ore and then what is the year-end adjustment. So when we purchase it, remember it's that 3 million. So I have an ore mine that I paid, the purchase price plus the additional cost. So it's 3,046,400 paid cash. So I'm crediting my cash. And then my depletion expense is 342,000. We just calculated that. And I have accumulated depletion. So it's worded a little bit different, but it's basically the same type of calculation. Okay, let's look at number 5. On April 1st, Cyclone's Backhoe Company purchases a trencher for $306,000. The machine's expected to last 5 years, has a salvage value of $53,000. So compute the depreciation expense for both years, December 2017 and 2018, assuming the company uses straight line depreciation. So remember, you got to check the dates. So this one we didn't purchase on January 1, that first year. It's April 17th. I mean, April 1st of 2017. Okay. So what is my, let's see, it's got, let me see how the table's set up. Choose the denominator. Okay, the numerator, denominator. So we have our cost minus the salvage value. So we have a cost of 306,000 less the 53. So we have 253. So that's our cost minus the salvage. Then we're dividing by the useful life of 5 years to come up with the annual depreciation of 50,600. So that's our straight line. The first year isn't the whole year, right? We got it on April 1. So we only have it for 9 months. So we're going to take the depreciation for the year, 50,600 divided by 12, multiplied by 9. and we get the 37,950 for the first year. Well, the next year in 2018 is a full year. So how much is it going to be? The whole amount, 50,600. So it wants you to set it up with your fractions. So calculate out your partial year. The reason why it's a partial year in 17 is because we bought it on April 1. Okay. Compute the depreciation expense for both years using double declining balance. Okay, so remember this one's a little bit different. We have to calculate out, what is it? It's 5 years. So what's 1 divided by 5? 20%. And then we double in that, it's gonna be 40%. Do we consider the salvage value when we calculate in that 40%? No. So we're gonna have to go back to what the amount is of the asset and then multiply that by the 40%. Okay, so for 2017, the beginning book value is 306,000. That's what we have as a cost. We're going to multiply it by the 40%. I just told you how we came up with that. It's a partial year, so that's the same thing. So we're going to have 9/12. So we have it for 9 months. And so my depreciation expense is going to be 91,800. So I reduced the 306,000 by that amount. My new book value is 214,000. That's what I'm going to use to calculate out the next year 40%. So I have 214,002 times it by the 40% for the whole year. Depreciation is 85,680. Okay, when it asks you your accumulated depreciation, what are we doing? We're adding that new amount, that 85,680, we're going to add that to the 91,800 because I'm also crediting that account, so it's getting added. So it's going to be 177,480 that I've depreciated so far for the first 2 years that I've had it. And the book value is now going to be 128,500. Okay, so we did 2 years for the straight line and we did 2 years for double declining balance. Just remember when you're calculating out that percentage, you take 1 divided by how many years it is. So it's 1 divided by 5 in this example to come up with the 20% and then double that. All right, so let's look at this one. So Raya Company purchases and installs a machine on January 1, 2018 at a total cost of 126,000. Straight line depreciation taken each year for 4 years, assuming an 8-year life and no salvage value. The machine is disposed on July 1 during its 5th year of service. So prepare to record the entries for the partial year depreciation on July 1, 2022, and record the disposal under the following separate assumptions. So let's do some calculations before we do that. So it's telling us that we bought the machine on January 1, and the cost was 126,000. We're using straight line depreciation. We assumed an 8-year life, and we had 0 salvage value. Okay, so we had 126,000 divided by 8. So that's going to give us our yearly. Divided by 8, so it's 15,750 per year. That's the full amount of depreciation. All right, so we had it for the year of 18. 19, 20, and 21 full years. So we have 4 years at the 15,750. So let's calculate out that. So 63,000. So that's my accumulated depreciation at the year end at 12 of 21. That's what it was. So now I'm disposing on July 1 of 2022. So it's wanting me to do an entry for that depreciation for 2022. So I'm not doing the full year. I'm only doing 6 months. So at 15,750 for the year, divided by 2. So it's gonna be 7875 for the 6 months in 2022. Hopefully I calculated that out right. We'll see. Okay. So on July 1, I'm doing a depreciation expense of 7875. Credit accumulated depreciation is 7875. Okay, that's to get my entry on the books. So now, what is the net book value? Let's figure that out. So I had 63. I gotta go back to this. Let's put it up here. I had 63. This is my accumulated depreciation, okay? Plus the new amount of 7875. Okay. That's the accumulated depreciation. And then the book value was 126. So what's my net book value? So I gotta take the 126 less the accumulated, which is the 70,875. So my net book value should be this, 55,125. All right. So it tells us to record the disposal under number 1. The machine sold for $63,000 in cash. Well, this is where I'm at right now. So did I have a gain or a loss? If I sell it for $63,000, a gain. So remember my asset was 126. This was my book value, 126 for that asset. That's what it gave me. And then this is what I accumulated over that 4.5 years, 70,875. So I have to deduct that from the value that I had initially, which is the 126. That gives me my net book value of 55,125. So anything over that is a gain. So I'm selling it for 63,000. So my gain, so I have 63,000 less that book value of 55,125. So it brings me back to the 7875. That's gonna be my gain. So I need to record that. So here's my cash coming in, 63,000. I know I got the cash. I need to remove the asset. How much am I going to remove that asset for? The credit to the machine is going to be for how much? Nope. Not the net or the accumulated. Remember with the assets, what we paid for it initially is what's in that account. So if I need to remove it, I need to do the whole thing. So what's the credit for? How much? What did I pay for it initially? 126. So now I got to take that whole thing off. That's my credit. I know that I have to get rid of my accumulated depreciation, which is sitting as a credit. So I have to debit accumulated depreciation for how much? Right here, the full amount. Let me get back to my pen right here. The full amount, 70,875. That was what I depreciated over 4.5 years. So I have to do a debit to get rid of that. So there's my cash coming in, 63,000. My accumulated depreciation, 70,875, because I'm clearing that out. Here's my credit to machine for 126. The difference, which we calculated already, we sold it more than that 55,000. So 55,000 was what the net book value was. We sold it for 63. So we already know our gain is 78.75. So there's the credit to gain 78.75. Okay, so that removes everything, records the gain. All right, so let's look at this different scenario. So now instead of selling it, I'm getting an insurance settlement of $52,920. It's received due to the machine's total destruction in a fire. So I didn't sell it, I lost it in a fire. And the insurance company only gave me $52,920. Did I have a gain or a loss? We had a loss. So everything's the same as far as what we depreciated and what our net book value is, right? That's all the same. The only thing that's different is the amount of money that I'm getting for it. Well, my net book value is $55,125. And my cash that I'm receiving is $52,900. So that difference is my loss because I have less than what I have as I received cash less than what I had on the books. So my loss should be $2,225. That's my loss. Okay, so when we do this entry, it's slightly different. We have cash coming in as a debit. The cash is going to be recorded for the $52,920. I still have to get rid of the asset. So it's going to be a credit for the full amount, the 126. I still have to get rid of that accumulated depreciation of 70,000. So that's my debit. Now I'm going to have a loss. Is a loss a credit or a debit? Remember? It's going to go on the income statement. So if it's a loss, is it going to be a credit or a debit? Nope. It's a debit. Yeah, because think about an expense. An expense is a debit. It reduces your income. The loss is kind of reducing your income because you're selling it for less than you actually had. So it's going to be a debit. So it's going to bring down your income that you have in. All right, so let's look at the entry. There's my cash coming in for $52,920. So always put what you know, okay, the easy stuff. You know you got cash coming in, you know the amount, debit cash for $52,920. We know how much we had as accumulated depreciation because we figured that out. So let's get rid of that. Debit the accumulated depreciation for the $70,875. Another very easy one is the machine. We know how to get rid of it because the original cost was $126,000. So I'm going to credit that off to wipe it out. And then I can do my calculation to see what's the difference in my debits and my credit. And does that match what I calculated as my loss and my gain? Should be an easy way to check. So the accumulated depreciation comes off and the difference, the loss is a debit and it's at 2,000, I had 25, but it's 2,205. So something I did on my calculator was wrong. Let's see. I had 55,125 minus 52,920. Yeah, 2205. I just put something in wrong. Oh, I forgot the 20 law right here. Should be that 55,125 minus 52,920. to get 2205. Okay, so that's a little bit messy, but hopefully you were able to follow it. You have any questions on that one? Okay, April 2nd, 2018, Montana Mining Company pays $3,439,860 for an ore deposit containing 1.5 million tons, 1533. The company installs machinery in the mine costing $198,400 with an estimated 7-year life and no salvage value. The machine will be abandoned when the ore is completely mined. Montana begins mining on May 1, 2018, and mines and sells 143,800 tons of ore the remaining 8 months of 2018. Okay, prepare the December 31, 2018 entries to record both the ore deposit depletion and the mining machinery depreciation. Mining machinery depreciation should be in proportion to the mine's depletion. So that's telling you how to calculate the depreciation expense for the machine, that it's going to be based on that same number that we're using for the depletion. Okay. All right. So it wants to know the entries for depletion. So we got to figure that out. Well, first you got to figure out how much it is per unit, right? So we got to look to see what we paid, the $3,439,860. And it tells us that the machine was $198,400 and has an estimated 7-year life with no salvage value. All right, so let's look at the depletion first. So we have the $3,439,860. We want to divide that by the number that they told us we would be able to get out, the tons, the 1.533, to come up with per ton. So we just divide it. It gives us 2.243875, which it'll tell you where it wants you to round, I'm sure. It wants you to round to the whole dollar. Okay, so when we try to calculate out what the depletion is for that year, we have to go back to look at how much did they say we took out for that year. It tells us that we mined and sold 143,800. So right here. So I take that number, multiply it by the per unit, which is the $2.24 something, and then round it up. So that 322,699. That's the amount that we use for the depletion. Okay, so we're just taking numbers they gave us. They gave us this, and they gave us this. So we just divide it. The number that you get, multiply it by how much we got for that year, and that gives you your depletion expense. All right, so on December 31, I'm gonna make my entry, depletion expense, 322,669, and then the accumulated depletion is gonna be 322,699. So now I gotta calculate the machinery. So it tells me that the machinery cost let me clear this off. $198,400. And I want to calculate it the same proportion as the mine depletion. So I'm not going to worry about the 7 years or the 0 salvage value. I'm going to look at the 198,400 divided by the 1,533,000 tons and come up with per ton. So I have 0.129419. And then I do the same thing. I take that number and I multiply it by what I mined that year, which was the 143.9, to come up with what my depreciation expense is going to be. So this is that number. This here. So I'm just taking 198.4 for the machine divided by the 1.533 and then come up with the per ton, multiply that by how much they told you in the problem that you were going to have for the year, which was this 143. And that gives me my depreciation expense. All right, so depreciation expense for the machine is 18,611. Accumulated depreciation is 18,611. Fun stuff. It's not that bad, is it? Do you feel like you understand it?
Yeah.
Y'all think y'all can do it on your own? Want to test? So do y'all have any questions about that? So next week is our test.